This is our portfolio update for the fall of 2023. Our normal disclaimer, as you've all become very aware of. A couple of things I wanted to highlight for the team, some new team members that you may not be familiar with right now. Andrew Sutherland has joined as a client service team member, Ryan Smiley in our South Surrey office. Carmen Gill recently joined the team as well as an advisor, and congratulations, Carmen recently got his full license transferred as a fully licensed investment advisor. So the team continues to grow. We've got our portfolio management and investment advisory team, plus our rockstar client service administrators of Christina and Mari that you're all familiar with. So any member of the team is always here to help you, be that with your portfolio questions, your financial planning questions, and or administrative questions. So don't hesitate to reach out. The team continues to grow. Normally the accolades section for our team, that is definitely a team effort. Any award that this team gets, be it from the Globe and Mail or within our firm, is definitely a team effort. So what are we going to focus on today? As you know, from a financial planning perspective, we can talk about managing your money. We can talk about managing the risks to your plan through things like insurance, reducing your taxes, managing your debt. But today we definitely want to focus a little bit more on discussing managing your portfolio, given the level of volatility that we've seen in numerous asset classes in 2022 and to some degree this year. So I want to start, with a slide or an analysis that we've become a bit familiar with. And this is a bit of a busy slide, so I'll walk you through it. But what it's really highlighting is I took two different portfolios and put it into our portfolio analytics software, our portfolio visualizer. Portfolio one, the blue line, is your traditional pension style of portfolio. So a 60-40 portfolio. Portfolio two is the prevailing interest rate that you would receive on cash in that year. So blue line, balanced portfolio, red line, cash. This is the accumulation period of somebody's life. So what I've done is gone back to 1997 and said for 25 years, adjusted for inflation, what would your $100,000 have done? Okay, and this is the actual returns. So a lot of the times you'll hear about average returns, and an average return can be very skewed over shorter periods of time, depending on how the markets have done. Now, what it shows you here is the average growth rate, the CAGR, compound average growth rate, for a balanced portfolio since 1997, even going through the crisis of 2000 to 2003, the dot-com bubble, the 08 crisis, and recently the interest rate increase, has averaged 6.25%. Now, to get that 6.25%, you had to suffer through variation. So you see that the line is not straight, okay? To get a 6.25% compound average growth rate out of a balanced portfolio, your annual returns could have been as high as 23% or as low as a loss of 23%. Whereas cash, your best year would have been 6 and you never lose money. This is why you'll hear us repeat again and again that if you are truly a long-term investor, you have to keep your time horizon in the 3 to 5 year range. So if you look at the bottom of the slide there, and it might be difficult to see, but maybe zoom in on your iPad or your phone. The worst you ever did over any 5 year period, and that would have been 2004 to 2009, with a diversified portfolio, was a drop of 1%. So if I keep my time horizon truly long-term, and I focus on the fact that these monies are there for me for my retirement, say if this is an RSP, then the risk to me of losing money over that extended period of time is not high. Now, if I focus on a year, say I have terrible timing, I invested all my money at the peak of 2008, that's when I opened up my RSP account. A year later, you would have been down 23%, okay? As long as you held on, by 2012, you were right back up to where you were. But it just shows you that even a balanced, diversified portfolio is not for the faint of heart in the short term. If you have a clear goal to have to utilize all of the capital in your investment, in other words, you're saving for a down payment on a house in the short term, or you're going to buy a vehicle or make a renovation, cash is your option. Okay, but over the long term, cash will lose. So interestingly enough, the reason the red line is flat to slightly negative is if you look in the middle of the slide where it says inflation adjusted, your 100,000 is essentially less than 100,000 25 years later. So what does that mean? It means that after adjusting for inflation, you do not make money in cash. Okay, let's repeat that. After adjusting for inflation, you don't make money in cash. Otherwise, there would be no capitalism. Okay, if I could make a 7% real rate of return, in other words, the return on my money after inflation was always positive and always high, we would use that investment all day long. But to beat inflation over time, you have to have the jagged blue line. Okay. Now, how do we build then your diversified portfolio? I just wanted to go back to Portfolio Management 101 a little bit and explain how it is that we come to the portfolio conclusions that we come to for you. We call this the Diversification Wheel. Remember, if we're investing your money for our team, this is money that you do not require all of within the next 36 to 60 months. If you come to me and say, I've got $1 million, what should I do with it? I will say, I don't know. And you may say, well, how can that be? You manage over $500 million. And we will say, because you haven't told me what the money's for. If you were to say, oh, I plan on buying a recreational property next year, we will use cash. Now, as soon as you say, well, this is money I want to grow and or derive income for over an extended period of time, say for my retirement, or it's a tax-free savings account that I want to draw on annually, or it's just an investment account that I want to supplement my retirement income with. This is where your portfolio comes into being. The core of that portfolio will contain 3 asset class holdings. Equities, which are another word for stocks or shares in companies, that's the growth portion. Income, which will include things like bonds, is the stable portion. And alternatives are exactly what they sound like. Alternatives to equities and alternatives to fixed income. We will use active managers and diversified pools to build you that core for the first $50,000 of an account. In each of our 2 pools, our equity pool and our fixed income pool, we've gone out and researched the best managers for you, negotiated fee savings, and put them all into tidy buckets. This is the Majestic Income Pool and our Platinum Growth Fund. We also use alternatives and have for many years in all of your accounts to further diversify our holdings. Things like Rise Properties, which invests in income earning properties for rent in and around the Seattle area. Antrim for mortgages, stable allocation to mortgage investments against principal residences in BC. Once your account reaches over 50,000, so from 50,000 to 250,000, we start to get exploratory with your portfolio, and we will add exposure to the broad market indexes. So this is where we can buy what's called an exchange traded fund that holds a basket of a number of securities, and we'll use that to further diversify your portfolio. So we might want exposure to things like commercial real estate, or we might want exposure to things like preferred shares, or extra exposure to specific equity market sectors. As soon as your account gets over 250,000, we will further diversify by adding direct investments into individual companies for you. So we'll go out and buy 20 to 30 stocks to further diversify the portfolio. So this is the exact same strategy that a major pension fund will use. Active managers, broad market exposure, and single stock positions. This is what we call R&D, rob and duplicate. So we look at pension plans managing hundreds of billions of dollars. I've been teaching with the municipal pension plan since 1999. We understand how they operate. They provide their pensioners with a lifetime income. We actually call our balanced growth 60% equity, 40% income portfolio the pension portfolio because it's modeled after these stable pension plans. So when you're looking at your account and you're a balanced growth investor with us, 60% stocks, know that this is completely modeled and mimicking what is happening in a broad-based pension. Okay, so it's important top down to kind of understand how we're building these portfolios. Now we're going to get a bit more into the nitty-gritty onto what you should be thinking about and looking at given the volatile time. So Vincent, are you there? There you are, Vincent. So I'll pass this over to Vincent.
All right, thanks, Robert, and good afternoon, everyone. I think now that Robert has gone through the process of how we build our portfolios, I think the next thing that most of you would want to know is what kind of return should be expecting. Like Robert said, we invest in a basket of different type of securities. So the return of our portfolios are coming from many different sources. So unlike the market index, which only focus on one type of securities, such as the S&P 500 index, which contain only US stocks, or the S&P Canada Bond Index, which contain only Canadian bonds, we invest in a basket mix of stocks and bonds from different regions, and as well as alternative investments such as real estate, mortgage fund, commodities, and hedge funds. And the benefit of investing in a basket will allow us to improve the diversification of the portfolio to reduce the overall risk and avoid the big drawdown like last year. So for example, most people would be invested in a balanced portfolios. Overall, the portfolio would be balanced between growth and income, where 60% is growth coming from stocks and 40% is earning income coming from bonds. And depending on your level of risk, the weighting for stocks and bond will be higher and lower. And for our stocks allocations, we further invested into different regions. So 50% we invested in the US stock markets, and 40% in the Canadian markets, and the 10% in the international markets. As for our bond allocations, we invest in the Canadian and US markets, bonds that are issued by the federal and provincial government, as well as some of the biggest companies in the world like RBC and Apple. So overall, in a balanced portfolio, you can expect 30% of your return will be coming from the US stock market, 24% will be coming from the Canadian stock market, 6% coming from the international stock markets, and the rest of the 40% coming from the US and Canadian bond markets. Now that you have a better understanding of the portfolio return, but how do you know whether our portfolio management team did a good job or not? And this is where the benchmark comes in. So a benchmark is essentially a standard we use to compare our portfolios to see how we have performed compared to the overall market index. So it allows us to assess and evaluate the active decision that we have made compared to invest passively. Since we invest in a basket of different type of securities, we cannot use a simple market index as our benchmark because the index contain only one type of security. We will have to customize our benchmark, or else we'll be essentially comparing a pineapple to a watermelon. Like most balanced portfolios lost around 15% last year, and we were down 11%. So the active management helped us to outperform the passive balanced portfolio by 4%, which is essentially like your house is down 5% last year, but everybody else on the street is down 10%. And I know so far a lot of people like to use GIC as their benchmark these days, because it has been more than 15 years since interest rates were at this level at 5%. But when you look at back in history, there are many periods where interest rates were high at 8, 10, or 15%. But GIC has never been able to outperform inflation and the market in the long term. And Elvis will get into more detail on this. But for simplifications, like we have select these passive ETF as the benchmark for today because they're fully transparent and have a very similar asset allocation and geographic allocation to our portfolios. So it can be easier to understand and compare to. So now comes to the headache part, portfolio downside. It's the one thing that we all hate, but it's also the one thing that we cannot escape unless you'll never invest again or put all of your money in GIC for the rest of your life. So unlike a GIC that move in a straight line, the market is very volatile and can move up or down. And the volatility is something that we have to live with in order to capture the excess return above the GIC interest. So essentially, especially in the short terms period, no one can really predict which way the market will go. Now, every month when you open your monthly statement, 33% of the time, it will be a down month. In a down year like last year, the number can go more than 50%. So it can be very frustrating when you're looking at the monthly return. But then when you stretch it out in a longer time horizon, like 5 years, over 95% of the time, your portfolio will be up. So essentially, it's like the same thing with your house, which is your biggest asset. House prices also move up and down each month, just like the market does, and have fallen more than the stock market from its peak. Except the market return is daily in real time, whereas your house is annually from BC assessment. And most people won't be concerned about the drop in house prices because it's something that you will own for more than 10 to 20 years. And by the time you either sell it or pass it on to your children, and so the short-term movement doesn't really bother you, and plus you won't really see the actual price drop unless you list your house and getting it appraised. And in 20 years' time, when you sell it, you'll only see the total gain that you have made, but you won't see the up and down in between. So as an investor, it is very important to look from a long-term perspective to see where your portfolio will be in the next 5 years or even a longer time period, and not get distracted by the short-term movement in the market. And now I will pass it on to Elvis to go into the details of how we manage and select security within the portfolio management team.
Thanks, Vincent, and good evening, everyone. I think it goes without saying that it's been a challenging and very stressful couple of years, but I do believe that the worst may be over and that better days may lie ahead. So I'll begin by just taking a step back to look at what's caused the volatility of the last 18 months. As we all know, the biggest contributor to this rise in volatility has been the dramatic, the incredible rise in interest rates over the past year and a half, going from almost zero to more than 5% at present. And this jump in interest rates is taking a massive toll on consumers, especially on people with excessive debt and large mortgages. If you look back at 2021, when we were in the throes of the pandemic and things were just kind of beginning to turn around a little bit, the central bank spent pretty much the entire year telling us that inflation is temporary, or to use their term, transitory, and it was caused by pandemic disruptions like supply chain disruptions and what have you. But from 2022 onwards, and of course well into this year, inflation has remained stubbornly high, and the North American economy has remained unusually resilient. And what's the central bank's response been? Both the Bank of Canada and the Federal Reserve have ratcheted rates up to their highest in many decades. And at the same time, they've been warning us that rates are going to stay elevated for longer than people initially expected. Now, I'm in the camp that believes much of the inflation pressure has been caused or has been intensified by the pandemic. If you recall, when it first erupted, governments transferred huge sums of cash to consumers to keep the global economy from falling apart. And at the same time, they also slashed interest rates to zero. But as we began emerging from the pandemic last year, there was such massive pent-up demand for everything from automobiles to travel to vacations that prices began going up across the board. And what made it even worse was Russia's attack on Ukraine, which triggered a price spike in oil and commodities. At the present time, things are slowly returning to normal. Things are beginning to normalize. There's less demand for many products and services, and this is causing economic growth to slow down quite appreciably, which takes me to my first slide, the case against cash. Like I said, markets have been exceptionally volatile, and in fact, September of this year was about as bad as I can recall it being. It seemed like there was no place to hide. All the asset classes were moving down together, kind of like March 2020 or October 2008, when no matter which stock you got into, it would go down, relentlessly. But here are some very good reasons why it's not the best time to sell everything and move to GICs. The first thing is reinvestment risk. You may currently get 1%, 5%, beg your pardon, for a 1 to 2 year GIC, but when it matures and you have to reinvest those proceeds, you might have to settle for a much lower rate. The second thing is liquidity. GICs basically lock you up for a period of time. The best rates that you would get would be on non-redeemable GICs. So that means you're really locked in. You get the 5 or 5.5%, but you have to pretty much tie up your money for a year or two. And as we all know, financial institutions are not very particularly cooperative if you need to access your funds before maturity. The next point is the real rate of return, which is the rate of return minus inflation. So the real rate is defined as a nominal rate, the rate that you see, less the rate of inflation. As Vincent mentioned, over long periods of time, GICs typically have very low or negative real rates of return. So putting your money in GICs for 5 or 10 years doesn't really result in wealth creation. It results in wealth erosion, because your principal amount and your, you may get a little bit of interest, but that's being eroded away. That's being eaten away by inflation. And historically, the best long-term real return rates always come from stocks. And finally, if you hold GICs in a non-registered account, of course, you get interest income, and that's taxed at your top marginal rate. Unlike stocks, which have a much more favorable taxation profile because of the capital gains tax and the dividend tax credit. So moving on to my next slide, why bonds may be better. So unlike GICs, bonds that are publicly traded are always marked to market. That means that their price, their present yield, reflects current market conditions, and the biggest determinant of that is, obviously interest rates or the current yield. So this means that the price you see online, the price that we see in our trading systems, it's an actual price at which we can transact a buy or sell for a bond or a bond ETF or a bond fund. And of course, bond prices have an inverse relation to interest rates or yields. If the price of a bond goes down, the yield goes up, and conversely, if the price of a bond goes up, the yield goes down. So last year, and like I mentioned, one of the biggest determinants of bond pricing is interest rates or the change therein. So last year, rates rose very rapidly, and bond prices pretty much fell across the board by about 10 to 15%. But this also means that in the next year or two, if interest rates start getting slashed, bond prices should go up appreciably. Now, when do interest rates typically start falling? They typically start declining, or I should say central banks start slashing or cutting rates when the economy is slowing down significantly and inflation is also declining. And central banks do this not out of the goodness of heart, but because they want to prevent a recession or to keep a economic slowdown from getting worse. And central banks also slash rates whether there's an external shock like the pandemic in 2020, or if there's a geopolitical event like 9/11. That's when central banks really take a hatchet to interest rates to keep the economy from slowing down too much. So what this means is when interest rates come down, bonds offer you the prospect of capital appreciation, unlike GICs. And of course, one really advantageous feature of bonds is that because they trade in real time, they're not really locked in, they're very liquid. So when we rebalance your portfolios, let's assume the market is down quite a bit and interest rates have come down as well. They are a really good source of cash for us to take money from the bond side of your portfolio and put it to work in equities. That's precisely what we did in 2020. And that's usually been the playbook, every time we rebalance. It's very unusual for stocks and bonds to go down in the same year like they did in 2022. And I think that's one of the few times it's happened since the 80s or the 90s. So this happens literally once in a blue moon. So moving on to the next slide, which talks about duration. This is a key feature of bonds that you may or may not know about. Duration really makes a difference when you're talking about a bond or a bond portfolio or a bond fund vis-a-vis a GIC. So I should mention that don't confuse duration with the maturity of a bond or a GIC. Duration in the bond context means sensitivity to interest rates or interest rate changes. So with the GIC, you're locked in for a period of time. It's got a fixed interest rate. So there's no sensitivity to interest rates. If you've got a 5% GIC, let's say the central bank goes haywire and ratchets rates up to 8%, your GIC will still give you 5%. If the central bank cuts rates to 3%, your GIC is still going to give you 5%. So there's no sensitivity. So there's no duration to speak of. But with a bond, like I mentioned, it's extremely sensitive to changes in interest rates. And for every year of a bond's duration, a 1% change in rates would mean a 1% change in the bond price. So if you have a bond with a duration of 5 years, if rates fall by 1%, its price will go up by 5%. If you have a bond or a bond portfolio with a duration of 10 years, if rates go down by 1%, the bond portfolio will go up by 10%. This is a very important aspect that GIC investors do not kind of recognize. It's really a big difference why in an environment where rates may go down significantly, it's much more preferable to hold a bond portfolio than to hold a GIC. And of course, the final takeaway from this slide is that the longer the duration, the more sensitive that the bonds are to interest rate changes. Here's an example of duration. It's a real life example from the pension portfolio that Robert alluded to. So essentially, we've got in the larger models, which we call the perennial class, which is pension, pursuit. For some reason, they all begin with the letter P. We essentially have 3 core holdings in our bond portfolio. One is the Majestic Global Income Pool, the Global Income Fund, which holds top managers from like PHNN, PIMCO, etc. The other one is a TD Fixed Income Pool. And the third one is something called the TLT. It's a Treasury Bond ETF, US Treasuries. Extremely liquid, extremely widely traded, one of the biggest holdings across the world of any single bond ETF. You can see the weights of those 3, relative weights of those 3 holdings in a bond, in the bond sleeve of a portfolio. The overall rating of this portfolio is A+, which is really, really good. So an A+ rating simply means that there's no junk bonds to speak of. So it'll hold up much better than a junk rated portfolio. Even if interest rates literally double from here, it'll still hold up really well. Let's talk about duration. The duration of this particular bond sleeve, of the bond portion of a portfolio, is about 7.1 years. So what this means is, if over the next year interest rates fall by 1%, then the yield on your bond is going to go from 5.1 to 4.1, in a manner of speaking. It might be a little bit more or less. But what you will get is an extra 7% in capital appreciation. So the total return from your bond portfolio would be 11%, upwards of 11%. If your interest rates over the next year or two fall by 2%, then because the duration of the bond portfolio is 7, you get a 7 times 2, 14% capital appreciation, plus the yield, which has now gone from 5.1 to 3.1. So you get a 3% yield. But the total return is upwards of 17%. Now let's say that this scenario doesn't play out, and in fact, interest rates go up next year by 1%. Looks really unlikely at this point in time, I got to admit, but let's say it happens. Even so, the total return from a bond portfolio, it's now going to give you 6.1 in terms of yield instead of 5.1. And because rates have gone up instead of going down, you lose 7% in capital, but your net return is still only minus 1%. So here's the risk-reward trade-off. Over the next couple of years, you might lose, say, 1%, 2% in terms of total return on your bond portfolio, but the upside is huge. It's literally a double-digit return. And I was at a BMO ETF conference last week. Robert and I and Aaron, Vincent, we've been speaking to money managers across the country. The thinking pretty much is that this is like a generational opportunity in fixed income. So really, really worth thinking about. Also, bear in mind that I was talking about GICs and reinvestments. If in 2024, let's say you've got a 1-year GIC at 5%, and it's up for renewal in late 2024, and interest rates have come down by 1% at that point in time, I can assure you that you will not be getting 4% on your GIC at that point in time. And why is that? It's because when banks set the GIC rates or deposit rates, they don't look at the current. They not only look at just the current yield, they also look at the trajectory of interest rates. And if they feel that interest rates are going to go down, you can rest assured that your reinvestment rate will be well below 4%. It could be 3% or lower, but that's how it usually plays out. On to the next slide. Just talk briefly here about how we use different holdings in your portfolio. And I think, many of your long-term clients of Luft Financial, you're probably familiar with the content of this slide. We use different holdings in your portfolio based on a number of factors: your investment objectives, your risk tolerance, your investment horizon. These inputs then get fed into IPS, and that's usually one of three. It's either balanced growth, or growth. Most of you are, I know, in the balanced growth kind of mandate, which is a combination of steady growth and income. So on that note, on a pension model, for example, the total yield on that portfolio, I talked about a 5% yield on the bond part of it, but even the equities, they give upwards of 3%. So if you look at the overall yield of the pension portfolio, it's somewhere around 3% plus. On the Canadian dividend model, which is a separate model that we have, it's more like 4%. So when you look at those types of returns, and this is all coming from extremely high quality bonds, extremely solid stocks with long-term records of dividend growth, it makes attaining a return objective of 6 to 8% so much easier, because you already have 3 or 4% in the bag, and you only need to generate 3 or 4% historically over a long period of time from the portfolio, which is eminently doable. On the next slide, I'll talk about the different holdings in our balanced growth models. And my apologies, it looks a little bit, I know it's probably a little bit hard to read. The point I want to make here is that Robert mentioned that a $50,000 portfolio, an account with 50,000 will have fewer holdings than an account with, let's say, $250,000. So a smaller account, which is, let's say, 50,000, it's probably in our pedestal class, and it probably has like maybe 5 holdings. If you come to a portfolio that's, let's say, upward of 200 or 250,000, you probably have as many as 35 securities in there, and as many of 22 of those will be single stocks. So the point is that even as the account grows in size, we make sure that it still remains very well diversified by adding the appropriate number of securities. In terms of core holdings, again, like Robert mentioned, one of them is the Platinum Growth Fund, which holds 9 fund managers. Top fund managers is doing extremely well this year. And that's basically the growth part of our portfolios, because the stocks that we own, the combination of value and growth, probably a little bit tilted towards value. So we rely on the growth manager in the Platinum pool to generate this extra torque for our portfolios. We also have the Majestic Global Income Fund that I talked about. And Robert mentioned alts, alternatives. Now, alts have a combination of equity and fixed income characteristics. And the reason that we add them to the portfolio is because they generally have low or negative correlation to stocks and bonds. So what this means is that when stocks and bonds go down, they might hold up in price much better than them. It also means that if stocks go on a tear, the alts won't do as well, but they still participate in some of that upside. And in fact, one really good feature about alts is, there are a big bunch of them, but let's talk about an equity alt that we own in most of our portfolios. It's from a company called Picton Mahoney. It's a long short fund, which means that it has the ability to not just buy stocks, but also short sell stocks, which is not something that you or I or Robert would do in our portfolios. It's a bit of a risky strategy. But we leave that part of it to the guys at Picton Mahoney. And when markets decline, long short funds do really well. So as an example, this particular fund that we own for you, that we hold for you, is up 4.2% year to date compared to the TSX, which is only up 0.6%. So that's a long short alt fund that we hold in our portfolios. We also hold a fund that actively trades commodities and futures. And like Robert mentioned, we also hold a mortgage investment corporation that churns out steady cash flow month after month. So it's a really good mix of securities that we own in our portfolios. Okay, we're now coming to the favorite part of of the presentation, my favorite part. How do we select securities? Actually, the one after this is the one I prefer even more, but let's talk about this for a moment. There's a lot that goes on behind the scenes that you probably don't see because, we have our annual meetings with you, we meet with you, we have webinars like this. But behind the scenes is a whole lot of research and analysis that goes into every single security that we put into our portfolio. A common theme with all of our investments is that they're high quality, whether it's a stock, an ETF, or a mutual fund. We don't hold crypto, we don't hold speculative stuff, we don't hold early mining stocks. What we're really looking for is a really good risk-reward trade kind of profile, and the ability to generate consistent, steady, stable returns over time with limited downside and a lot of upside optionality. That's what we look for. And you simply don't get that with a lot of speculative stuff. So also to eliminate any bias, there are 4 of us on the portfolio management team, Robert, myself, Aaron, and Vincent. And it's a very democratic process. It's a very equitable process. We make decisions by committee. Because we're a smaller firm, our decisions are really quick. So we can turn around on a dime. If we decide that the stock has met our price target or we want to cut a position, we can do that really quickly after a quick meeting. And at least twice a year, we conduct an in-depth analysis to determine asset allocation. Because that factor, asset allocation, is the single biggest influence on your portfolio returns. So we spend a lot of time in doing a really exhaustive kind of deep dive into where the markets are, what are the upside, what's the upside potential, what are the downside risks, where do we think currencies are going to go, the Canadian dollar is going to go the next year, what do we think of interest rates, stuff like that. We put all that into our big spreadsheet, and then we base our investment decisions on that. And like I said, we review that at least 2 or 3 times a year. Now, I began my career in Canada in equity analysis, so stocks are something that I really enjoy doing. And I just wanted to talk to you briefly about how we select our stocks. Now, one thing to remember about individual stock positions is that there's always going to be much more volatility than you would find with a mutual fund or an ETF. That's because funds and ETFs are big baskets. So if something goes up, the other one will kind of counter that downside. But as we've seen, even broad market indices can go down 20-30% in a year, like they did last year. So when we select stocks, we try to pick the cream of the crop. We try to pick stocks that we think we're going to hold pretty much forever and that we have a lot of conviction in. And it also means that Robert and I and Aaron, we pretty much own almost all the stocks that you would see in your portfolios. I shouldn't say almost all the stocks you would see in your portfolios. So when it comes to picking stocks, our investment style is a combination of what's called bottom-up or top-down. So bottom-up stock picking means that we may pick a stock regardless of its sector because it has an attractive risk-reward profile. Top-down means that, like I mentioned, we do the asset allocation exercise, then we drill down into the sectors that we like, and then we drill further down into analyzing, the stocks within that sector, and then picking the 2 or 3 best ones in that, and then we'll put our money and your money into it. So I'll demonstrate with an example. A year ago, markets were already down 15-20%. There was overwhelming fear of recession. So what had happened was there was a bit of a paradox. Market indices were down quite a bit, but there were also some very good buying opportunities in specific sectors. So what we decided to do was we kind of went defensive. We played defense. And this is a classic kind of tactic when you think markets are going to go down. You stick with the sectors or the stocks that will go down less than the overall market and will kind of give you upside when the markets turn around. So classic defensive sectors are ones like utilities, healthcare, consumer staples, telecoms. And that's because, come what may, people are going to pay the utility bills. They're going to pay their TELUS or Rogers bill for their phones and whatnot. They're going to be doing the grocery shopping, buying food. So these stocks tend to hold up much better even in a recessionary environment. So like I mentioned, a year or 2 ago, recession fears are paramount. We decided to go defensive. So what we did was we sold broad ETFs like the XLF ETF, and that turned out to be a really good move. The XLF ETF is a US financial sector ETF, and that ETF kind of lost, 15% back in March of this year when you had those 3 or 4 US bank failures. That was a good move. We sold at the right time late last year. We also sold a broad Canadian dividend ETF called PDC. And what we did with the funds was we deployed it into stocks, world-class defensive stocks like Fortis. We all know Fortis, the biggest utility, the only utility in BC pretty much. We also bought Brookfield. We bought a giant global consumer staples company called Unilever. We bought the biggest maker of medical devices called Medtronic. So these are all kind of top-down stock picks. One stock that we added, which is Salesforce, it's very big. It's a global CRM, customer relationship management company that we use at Luft Financial as well. Salesforce was down 40% or 50% at this time last year. It was, it had got decimated. We looked at it. We said it's got a really good valuation, looks very attractive on a long-term basis. So we added Salesforce to our portfolios, and that's an example of a bottom-up stock pick. And I think year-to-date, Salesforce is up like 55%. So it's done really well. I'm now coming on to the final couple slides. So just very briefly talk about a few more points here. So what we do on your behalf is we do active asset management, which means that we research portfolio holdings, we select the best ones, we actively trade them, we monitor them 24/7. As opposed to active management, passive management means that you simply invest in a benchmark in an ETF or a fund that tracks a benchmark, like the TSX, S&P 500, or the NASDAQ. Now, the goal of active management, in our case, is that we want to minimize the downside risk. We want to smooth out fluctuations in the market. We want to generate stable returns. Many people say, why don't I just put my money in an index? What's the point of doing all this? Well, here's the thing. Being in an index, whether it's a TSX or the S&P or the NASDAQ, exposes you to a great deal of volatility. Like look at last year, S&P down 19%, NASDAQ down 38%. In previous years, we've seen declines in the S&P, in the TSX composite of like 25-30%. So that's a huge, you do have the upside potential. It comes with a lot of downside risk too. The other very important point is that when you invest in an index, you may be overly exposed to a sector or sectors that may not be optimal. Case in point, Canada is a great country. The TSX composite is a fantastic index, but the problem with it is it's very deeply cyclical. What I mean by that is it's very heavily exposed to the economic cycle, because it's got a 30% weight in financials, and it's got 1/3 of the index, like 32 or 33%, in just two sectors, energy and materials. So that's over 60% of the index that's just in three very cyclical sectors. And in a period like 2003 to 2007, when the China story was, in full bloom and commodities were on a massive run, benefited the TSX tremendously. It's been a very different story since then. The TSX has very little exposure to healthcare and technology, which are two massive areas in the US, but we've got very little exposure to them. So it makes a lot of sense to be well diversified across sectors, across geographies, across asset classes, and that's what we do. Just want to talk very briefly about fine-tuning our process. It's always an ongoing process for us. We keep looking at the optimal mix of stocks, bonds, ETFs in your portfolio. So, for example, sometimes you might decide that a sector like technology, really hard to pinpoint the best stock picks in that because it's a huge sector. It's like a number of different sectors in one. You've got software stocks, you've got chip stocks, you've got hardware stocks, you've got service companies. So in that case, an ETF makes a lot of sense as opposed to trying to pick a single stock. So when I say we're fine-tuning a process, this is what I mean. We might sell a stock like Qualcomm and opt for a tech ETF, fairly soon. In terms of self-discipline, this is something that we continue to fine-tune as well. I'll give you the example of Disney. When we invested in it in March 2020, over the next 12 months, Disney went up by 135%. That was a crazy stock surge. I mean, a lot of stocks went along for the ride, but in the case of Disney, what made the difference was the overwhelmingly popular rollout of its Disney Plus streaming service. But fast forward to 2 years later, and at this point, it's a very different story. Disney is down in the dumps because there have been a bunch of different things that have gone wrong for the company. But we view it as a long-term kind of opportunity. It's a fantastic company. It's got an unrivaled set of assets. The valuations are fabulous, and we really think when the dust settles and things become a little clearer over the next couple of years, the stock is going to do extremely well. And finally, I'll just talk very briefly about something that I've mentioned on our previous webinars, but just a refresher on how we rebalance your portfolios. We rebalance your portfolios quite frequently, at least once a quarter, sometimes more often. If you see the market sliding, like let's say the market's down 15% in a period of 2 or 3 months, you can rest assured we would have rebalanced your portfolio at least 2 or 3 times in that period. We've got a bunch of robust, what we call rebalance criteria that trigger rebalances across all our models. So essentially, we look at, let's say the last time we rebalanced, the S&P was 500 was at 4,500, and the TSX was at 20,000. So if we get a deviation of 7.5% from those levels, whether on the upside or the downside, we will rebalance your portfolio again. If we see a number of stocks in the portfolio that are, again, up or down quite significantly from the last time we rebalanced, like 10 or 15%, we will rebalance. The point is we're always actively buying and selling securities in your portfolio. And I just want to reiterate that, when it comes to managing your money, there's a great deal of activity that goes on behind the scenes, but we always do this in a prudent manner and with your best interest at heart. So I've taken up a significant amount of your time. Thank you so much for your patience in listening to me. Be very happy to take any questions, and I'll now turn it over to Robert.
Hey, Elvis, thanks. That was great.
Thank you,
little glitch there at the end. It's like you froze and then you were talking very rapidly. I don't know.
Might have buffered that and
buffered, and then you were speaking very quickly.
Okay.
Great. So we've still got plenty of time here. It's 4:30. We started a little bit late, so there's still quite a few people, obviously, on the chat. I'd encourage you, if you could, to go into the chat and ask some questions. I'm going to address a couple of them that came out, and one of them I think will kind of shed a little bit of light for everybody. That one being a question that we got early from Lori Holland, which was, I seem to have a third of my money in 2 funds. And Lori and everybody, if you recall the slide I showed on the overall, the way we build the portfolio, so that core slide, let me just share my screen here. I'll show you what I mean here, and I'll share this. So if you recall what I was explaining, the core is built with equity, fixed income, and alternatives. These are diversified pools, okay? So these diversified pools where you're saying, Lori, well, I've just got, or anybody might say, I see these 2 line items. So what I'd encourage you to do is go into the IA Private Wealth site, okay? In that site, what you can do, I'll share my screen again here. There. When you log in, you can actually go directly into a holding within the IA Private Wealth site. If you click on any of the fund holdings, what you'll see on your statement, you might see, oh, I've only got this one holding. But as we've explained, when we built our portfolios, we took all the mutual funds that used to be in your accounts, which are diversified and run by active managers, and we pooled them up. So on your statements, you see what seems like one fund. That is not correct. This is a pool. Within that fund, you can see that there are a number of different holdings. So within the Platinum pool, for example, are 9 managers and a passive ETF. Okay, highly diversified by asset allocation between US, Canadian, and international, by sector, and by geographic allocation. This is the exact same thing if you go back to holdings, and then I'll do this by market value again, and then you look at the Select Partners Income Fund, which you will see. So this is your fixed income portion. So you see a line on there that says MAG 383. This is diversified with 10 of the biggest bond managers. So even a portfolio with us that has $50,000 will actually essentially have 23 holdings. Okay, those two pools are fund of funds. So that Majestic Select Partners Global Income Fund, as well as the Platinum Growth Fund, are huge portions of our portfolios. Okay, so it's really important to remember that these are not just two funds. Okay, does that hopefully that clarifies that? Like if we just broke them out and showed them and a look through on your statement, you'd see 20 holdings. And we meet on a regular basis to determine which managers can make it into the pool. And think about it. Our equity pool is over 100. What is it now, Elvis? 140 million, 150 million. It's big.
125.
Sorry, 125. Sorry. And when a manager wants to be part of that pool, they're looking to get a large allocation of capital. So we can grind them on the management fees that are completely passed on to you. We don't take a management fee in that pool. And so we save you money, and we can get a reduced management fee from the fund company, and we can easily trade those funds. So hopefully that answers that question. That is the active part of your portfolio. So remember, 1/3 active, 1/3 ETF, 1/3 passive. So the question now these coming back with is, how do we rebalance when we have those? So we can make one call within those pools, Lori, and we can rebalance the entire pool. So we could say we want to sell 5% of this fund and buy 5% of that, and in a single day move millions of dollars within the pool.
Robert, there's a question here from Brad about whether we're expecting a recession.
Mm-hmm.
So, I mean, the market's been kind of waffling about this, Brad. Sentiment seems to turn on a dime, and one day it's like, oh, we're headed for a deep recession. One day it's like we're not. I think a couple of things that have changed over the last 3 months is that, especially in the US, there was a lot of talk about something called a soft landing, whereby the economy would slow down without going into recession. That still might be a possibility out there. I think it might be a different situation in Canada, where because of the debt load in the housing market, if a recession does happen, it might be more severe than the one in the US, which is why it makes a lot of sense for us to have significant amounts of exposure to the US market in addition to Canada. The other thing to note is that the consensus call across is that if there's a recession in Canada, it still might be a pretty mild one. And also, markets move down well in advance of a recession. So it's very difficult to kind of time entry and exit into markets based on the recession call. But like I mentioned, we are still defensive. We're actually thinking of increasing our equity exposure a little bit, because I think by the second half of next year, we might be on a sustainable run upwards. So even though recession might look like it's bearing down on us, hopefully it's only a shallow recession, and the markets should recover pretty quickly.
My answer to that too would be assume the worst. Okay, I look back at, say, the worst period of time you could have started with us would be like the year 2000. And look back at the year 2000 when the dot-com bubble burst, we had 3 negative years. Okay, so a diversified balanced portfolio would have gone from 100,000 per 100,000 all the way down to $84,000 cumulatively. And you would have had to bear 3 years of saying, I'm down 7, the market's down 20. I'm down 5, the market's down 10. This is going to test your patience. This is 1 year. So I wouldn't, if we're down 16% last year in an average balanced portfolio, we're only down 10. But last year, the US stock market was down 20. Okay. If the consumer rolls over, and the consumer being 1/3 of GDP, stops spending, their house prices in Canada start to falter because their mortgages are coming up for renewal. Let's assume the worst, and you go into a recession. Remember the time horizon you have for this money. Okay, if this is your RSP, it might have to last you for 25 years. If you think you're going to be able to make the call to get out of a diversified portfolio, hop into a GIC, and come back into the diversified portfolio, you're wrong. What will happen is the markets will move ahead of the time you decide to come back in, and you'll have missed the best days in the markets. So this is that old adage of don't try to time it. I would assume we could have two bad years. None of us know. Remember what I said, to get a 6% average in your portfolio, annually you could be making positive 23 to minus 23. If we knew exactly which sector to allocate your capital in, we'd put all of it in that sector right now, right? So I think what you really have to ask yourself, this is a bit of a gut check, right? If you have a 36-month to 50-month rolling average return expectation, that's fine. If you thought you were going to make a positive return every single year on your money, the only way to get that every single month out of a portfolio is cash, and you will consistently lose money to inflation over time. I think that's the best way I can answer that question, because none of us knows. I mean, you can look online, and if you go down the rabbit hole, you'll find enough stuff to worry you about how bad things are going to be.
Sorry to butt in, but I mentioned at the beginning of my presentation that we can hopefully look forward to better times. I jotted down some reasons for optimism. So here's the thing: earnings and earnings expectation, drive the market to a very, very large extent. And I've just come across articles that talk about the fact that for the S&P 500 in the US, earnings estimates were coming down for companies, but now they have stabilized and they're starting to creep back up. So what this means is the bar for earnings has been lowered quite a bit, and we will start seeing the first earnings reports come from companies in the US in the next week or so. And if they're better than expectations, then we can look forward to a pretty solid end to the year. The other thing is that US consumers are sitting on about $1 trillion in cash that they built up during the pandemic. And this is higher than expectations. People were thinking it might have come down to like $500 billion, but that's not the case. It's about $1 trillion. So this could really boost the probability of a soft landing there. The third most important point is that we, both in Canada and the US, we are very close to the end of the rate hike cycle, more so in Canada than in the US. And that's the one thing that's been causing a lot of pain across multiple sectors. So once you see the rate hikes kind of top out, it's going to give a lot of relief to consumers and to the Canadian economy. And finally, seasonal strength. The fourth quarter is typically the strongest for markets. I don't see any reason why it could be any different this time. The one wild card is this Middle East conflict that erupted over the last week, but we're keeping a watch on that. And there's a risk to the markets if it widens, but at this point in time, let's hope it stays in check.
Robert, did you have something?
Yeah, no, I was just going to keep answering the question. I wanted to get to Doug's question about withdrawals and withdrawal rates.
Yeah, we also have a question kind of tying all into that too from Barbara. And her question was, I'm just retired. I'm concerned I will not recoup everything I've lost over the last 2 years. So, when we're looking at your investments, as, Robert and Elvis has gone over, if you're looking over the last 2 years, then most likely you're taking the highest point possible of the markets when it peaked in November 2021 or the end of 2021, which is essentially 2 years ago to today. Now it went down and kind of bottomed near the end of 2022, and this year it's a little bit up year to date. Now the important thing about the timing of retirement and your plan is that although you might retire today or in a year from now, or maybe you retired a year ago, is remembering that just because you retired does not mean that you're spending all of your RSP or your retirement savings within the next year or 2 or 5 years. These accounts are meant to last, say, another 10, 15, 20, potentially 30 years, depending on how old you are when you retire. So although you have recently retired, you still have a long time horizon. And as they've shown, through the history of the markets in a balanced portfolio, as we use in our examples, you are going to have those good years and bad years. But if you look over a 3-5 year period, the probabilities of having that positive return and getting back to those peaks is really high. So what I would say to that is just continue to focus on the longer term, ensuring that your withdrawal rates and managing your cash flow is appropriate to the size of your portfolio. Now, if you take a large withdrawal out immediately when markets are down, that obviously have a larger impact. But if you're taking in the kind of recommended pension-like withdrawals from 4 to 6%, that should be fine, and that would be acceptable.
I think one of the easiest things to do when markets are volatile, Doug was asking a question, I want to draw down my money, but I don't want to take out the principal, is think about how a pension plan operates. Okay, like the BC Investment Management Corporation. You give them your money in your public service pension. They invest that in a diversified portfolio. And once a year, they send you a statement that says, this is how much you can expect to get if you retire at this point. Okay. With your own RSP, what happens? You invest the money, we diversify it for you, but every month we send you a market value of what that portfolio is worth. So we are focusing you, not us specifically, but the way the regulations work, and you have to get a statement every month, we're focusing you on the short term. So that creates behavior that defies the long-term objective you have for the portfolio. So what I explain to people in periods of time like this is to go, look, every month get your statement. Now, instead of comparing the value of your portfolio to what it was worth the month before, and remember, it's going to be negative 30% of the time. So think about that. You're going to be upset 30% of the time. To alleviate that emotional concern, multiply the total value by between 4 and 5% if you want to be conservative. Pensions will use a 5.2% distribution on capital to the retirees. So if we want to be conservative, say for every 100,000 you get, you multiply that by 5%. That's the annual income you could expect from your portfolio. So for every 100,000 you saved in your RSP, remind yourself that's $5,000 a year in pension. So if you've got 200,000, that's 10,000. If you got 300,000, that's 15,000. Even if you started at the worst possible time, and you did that over the past 20 years, and we rebalanced you like we have been, you would not be out of money. You would be out of money if you had cash. Okay. Now you may have to go through 3 years where you're seeing your portfolio go down at a rate that you're not comfortable with. So you can reduce your redemptions in those amounts. So Doug, for example, if you're concerned about drawing principal, what you remember is 40% or so of your portfolio is going to be invested in things that are generating income. So reduce the amount that you would expect. If I've got a portfolio making 3% income, and I don't want to touch capital as much, I might only do a 3% redemption rate during a recession, which is why we say going into retirement, it's good to have a little bit of extra cash around so that you can provide that buffer to reduce the amount that you draw from your portfolio. Hopefully that answers the question.
And also remembering that your RSPs, which turn into RIFs, and your LIRAs that turn into LIFs, are designed by the government to go down over your lifetime. As you age, you're forced to take out more, and they are meant to be spent. It is an additional pension for you to spend and use. So dipping into that principal at some point, you have to as well. Now, TFSA is non-registered. That's up to you and your estate plan. But for a registered account, those are going to gradually go down.
Doug, you're saying I haven't drawn anything yet, and being it's down, take the total value of your portfolio, multiply that by 3 to 4%. That's the pension expectation you should be comfortable with. Okay. It depends too what you're looking at as your quote unquote your high watermark. A lot of the times people will look at their portfolio like their house and remember the most it ever was. Okay. Look at the value it is at any given time, and determine that that's the amount that you draw.
Robert, there's a question here about how do we rebalance when you've got two large pool funds? You want to tackle that?
You can.
Okay, all right. Over to me. So essentially, we rebalance around these two pooled funds because, as Robert mentioned, these are core holdings, but it also means that we monitor them all the time and we make changes in those funds as appropriate. As an example, a few months ago, we sold a TD fund that was doing really well, and we I think it was up like 30% for the year. So we deployed those proceeds into two or three other funds that we thought had a better kind of reward profile without altering the composition of the exposure of that fund. In the months ahead, we expect to make changes to the fund by increasing the non-US component of it. So that's for Platinum. On the fixed income side, there's four of us who sit on the investment committee, three of them from our other teams and myself from Luft. And we monitor it. We have meetings every month. And again, we hold managers like PIMCO, PHNN, BMO, Dynamic. We have a call with one of the managers of that fund every single month. It's monitored very closely. So there's an aspect, there are two separate aspects of rebalancing. We rebalance your portfolio around these funds. We will buy and sell them as appropriate. And we also separately rebalance those two pooled funds independently of the rebalance that we do in your portfolios. Doug's got a question on can you recommend stocks like you did with Disney and Salesforce? Robert, couldn't hear you there.
Yeah.
Better.
Sorry, guys. Sorry.
Doug, I don't know how to answer this one, but you'll probably see that in your portfolio before long. Any new stock picks that we put in. And if you want any additional color on any of the stocks that we hold, feel free to reach out to me and be happy to chat.
And just a reminder, because I'm not really clear on that question, Doug, can you recommend stocks like you did with Disney and Salesforce? The stocks that we talked about today, any portfolio that we have for a client where you've got over 250,000, with one of those perennial models, you're holding stocks, you will hold all of those stocks in your account. You'll just have different percentages in the account depending on your risk tolerance. So the growth investor will have the exact same stocks as a balanced growth and the balanced investor, just higher percentages. And I own every single position that we own. I'm the largest holder of the Platinum Growth Fund and the largest holder of the Majestic Select Income Fund. We eat what we cook. Okay, so we're not going to put something in your portfolios that I don't already own. So you already have Disney, Berkshire, Visa, TD Bank. A ton of debate happens within our team before a stock gets added or withdrawn. So you know that you will hold the stocks in the portfolio. Mortgage rates, there was a question on. Did anybody see that one? Is that the one from Tammy Hamill?
Yeah.
Okay. People that are paying. Aaron, you want to take that one from Tammy?
Sure. It was on the other side of the chat here, so just give me a second. So variable rates, mortgages, as rates have gone up, people are obviously having to pay more when they renew, or depending on if their variable rate was kind of a fixed payment and now they're paying on a longer amortization, or just paying interest, or potentially increasing the amortization, not even covering it. Those are the kind of three options that we've seen. So when we're looking at your financial, for people, I'll speak more generally, it's almost financial planning. You're looking at your cash flow. So you want to see kind of what's coming in and what's going out. Now, if you're unable to make that payment and it's really impacting your your retirement life or plan and you need more money, then yeah, we look at, okay, well, again, yes, can you draw on those investments? Absolutely. You want to look at what Robert was talking to, taking out that 4 or 5% or maybe what you need to potentially bridge this gap until rates do start to come down and your mortgage payments will lower again. Just looking at the different sources of income that you can tap into. Maybe someone hasn't turned on their CPP yet or what have you. So kind of looking at what your needs are and how long, making a plan of whether it's, a year, 2, 3 years of cash flow, part of your financial retirement income plan to, get us through this period of higher rates, as well as maintaining your life, right? Still doing the things that you want to do if you're in retirement. Now, taxes are obviously a consideration as well, but that's why you got to look at the full plan there.
I think what she was asking though is, she's on a variable, and when's it better to go to a fixed? So if you're on a variable, a lot of the variables that people had were you're going to be at 7.2% minus maybe 100 basis points. You might be 6.2. You can get a fixed right now if it's at a reduced rate on a 3-year. I'd be advising people on a new mortgage right now to go to a 2 to a 3-year fixed. If central banks lower rates, guess what that means? We've gone into a nasty recession. So it's going to be crappy economic times, and then they'll have to lower. So, when you say, is it worth sticking it out until they start lowering? Well, we don't know when they're going to start lowering. It'll have to be when inflation is gone down. So if you can't make those payments, if you're paying considerably more right now on a variable mortgage, you might want to see if it makes sense to break the mortgage and go to a 2-year fixed. There's going to be penalties. Drawing out capital from your long-term portfolios doesn't make sense. If you're drawing money out of an RSP or a locked-in account, for example, it's going to be taxed. So you might pay 30-40% tax on the withdrawal to pay down the debt. This is going to be a common theme. There's approximately 20 to 25% of the bank's mortgages on the books that are coming due over the next 12 to 24 months. They're setting aside provisions for credit losses. They expect there's going to be defaults. So to get you through this, Tammy, I would expect that interest rates will stay higher than you expect for longer. So you will have to find areas in your plan to make up for that. Any other? There's another one there. Does somebody want to handle that one?
Just from Barbara?
Yeah.
Yeah, just to kind of, again, because I answered the first part of that, to piggyback on the timelines. When we look at over history of a balanced portfolio of, how well it's done and how often it's positive and over how long, and we're looking at those 3 or 5 years. Remember, we're already 2 years into this as well, right? So if you're still on that 5 to 10 year time horizon from today, that's still a good chunk of time, as well as already.
Does she mean though, Aaron? Sorry, does she mean 5 years to draw it to start taking it out, or she wants to spend it in 5 years?
It says down to zero. In 5 to 10 years, draw it down to zero. So, I'm assuming starting it now. Now that's an aggressive withdrawal rate of taking it out. In 10 years, that's 10% a year. 5 years, that's 20% a year.
I would say if I was going to do that very easily, if you're going to spend all that money in the next 5 years, then, or 10 even, then you probably want to have a cash wedge equal to 3 years of it. Yeah.
Yeah. So again, kind of revisiting the whole plan with your, with your lead advisor, and kind of making that plan to get through over the next, whether it's year, 2, 3 years of withdrawals, and kind of a plan of what you're going to have, and building out that cash wedge or where that money's going to come from, and then hopefully letting the rest of that still, recover, compound, and grow, and earn the yield off of that, or over the 7. If we're looking at 10 years, the 3 to 7.
Logistically too, let's remember, everybody, that we always keep, when you go into withdrawal with us, if you're taking a big wrong word, but if you've got a RIF and we say you're going to take out $5,000 per year on your 100,000, we will keep 3 to 6 months of cash at any given time in your portfolio. So Elvis, Vincent, and myself, we're not selling every month to free up the cash. That cash, if you look, is in there as a cash wedge. Barbara, if you said you're going to spend all the money in your account in 10 years, and you're going to be drawing out 10% a year, then I would be going to my lead advisor exactly and saying, I want to keep 30% of my portfolio in cash then. So then you wouldn't touch the other 70%, and you've got at least 3 years before you draw it. That's not normal to have. You would have wanted to communicate that you're going to, hey, I've got $1, I'm going to spend all this money over the next 10 years. Usually at an RSP, you're 60, you're spending it by the time you're 75 or 80, right? And we will always keep a cash wedge. If you want to be really conservative, if somebody's got their 100,000, you might keep 20,000 in a high interest savings account and 80,000 in a diversified portfolio. So that 20 grand will fund at 5,000 a year, 4 years of redemption. So you don't have to worry about it. That would be like going through a 2000 to 2003 crisis, right? So you think if you thought the sky was going to fall and everything was going to go to heck in a handbasket, of your total long-term portfolio, you just allocate more to short-term cash.
And within that 5% pension kind of payout withdrawal model, in today's rate environment on our portfolios, as Elvis alluded to and showed us, was that they're ranging in that 3 to 4% yielding as well. So when we're taking out that 5%, hopefully in that range, a good half of that is coming from the income from the portfolio as well. So when we're talking about having to sell, we're not having to sell things every single month. And even when we are rebalancing, or in any market, even in bad markets, we have areas in our portfolio that have stayed positive or earned income, even in the worst of times. As our look at our mortgage funds and other investments that have inverse relationships sometimes to what's going on within the markets.
But we have options. I would also remind people that sometimes things happen in a catastrophic way. Last year was the worst year for a balanced, diversified portfolio since 1937. The U.S. stock market dropped 19.6%, and the global bond markets dropped 17%. That doesn't usually happen. Okay, so when we think things aren't going to happen, they generally happen that way. If consensus is 100% one way, you can bet your bottom dollar that it's going to go the other way. So I look at this and go, this could be bad for 2 or 3 more years. If you had to push me on where I think you're probably going to make the most money over the next 5 years, it could be in the bond market. As Elvis aptly pointed out, if interest rates do come down, there's going to be capital appreciation on the bond portion. But you have to act as if the worst case is going to happen. So right now, we will be consistently saying to you, we did a good job if your balanced portfolio goes down 10 and the stock market goes down 20. And we don't know when this is going to end, but it doesn't make sense to go to cash because you'll miss the uptake. I've been through we went through this 2000 to 2003, 2008. Look at COVID. If you went to cash like so many people did in March of 2020, it seems so far away now, you lost your shirt, right? How many people were thinking that the world was going to be over? I said, well, if it's over, none of this matters anyway. So now that's a harsh way to think, but this is what you have to look at. You got a diversified portfolio. When times are bad, you got to hold the line. We keep rebalancing and it'll come back. More questions? Okay. I'm going to answer Dave's because I think this will answer a lot of people's questions. So Dave had a really good question. I want to take out 6. Am I going to draw it too fast? So Dave, here's what I'm going to do. I'm going to go back to the worst possible year you could have been an investor. for everybody. And I'm going to share my screen a sec. And I'm going to say you put $100,000 away in your portfolio, and you took out $500 a month per 100,000, so 6%. And you indexed it every year, and you started at the worst possible time. Okay, the worst possible time would have been 2000. Your average return over that period of time would have still been, starting in the year 2000, 5.19%. Now remember, that's indexing it to inflation every year. Okay, so Dave, I would think 6%. If it's a bad year, you might want to try doing 5% the first year, if possible, out of a pension. But even if you did 6%, you started in the year 2000, your money would have lasted you 20 years. Okay, now that's starting at the worst time you could have since 2008.
There was a question in the chat just about TFSA, using that to pay down a mortgage that's coming due in June of 2024. Now, that's always an option because TFSAs are great in that way that we can access that cash tax-free at any time to do, whatever we want with it, whether it's a reno, pay down some debt, go on a trip, it's always there to access. Now, in June 2024, with current rates and what's going on in the world, for clients that are in a fixed rate mortgage at 2% or what have you, that's still, a lot can change. It's not that far away, but a lot can change between now and then. So, we don't know exactly where rates are going to be. If they're still elevated or quite high at that point, then that's, probably something that you want to consider. But if we're watching rates kind of trending down and you like to have have some cash that you need to or want to have access to, you may want to keep it out. And really it also comes down to people having, how big is that mortgage? What is your monthly cash flows like? Is it like when you come to renew at the new mortgage, is that going to eat up all your monthly cash flow? Are you kind of forced to paying some of that down? So it's not like a one size fits all answer for that, but we're still, like I say, there's still 8 months out from that, and we're still getting a lot of information on which way, rates are kind of going. We don't necessarily think they're going to be a lot higher, but as Robert also alluded to, kind of higher for longer. But if we're starting to see them trending down and you are in a variable or something and you're looking to kind of ride that down, that's an option. But I wouldn't get too ahead of myself right now thinking about June.
The other thing I would suggest there with that is you can use partial assets. Remember, you have a diversified portfolio in your TFSA, so we can sell partial assets that aren't down. For example, the fixed income components. Adjust your investment policy to a higher growth and sell some of the fixed income. I want to answer the question about inflation. So indexing to inflation means every year you look at whatever the inflation rate was. So in the year 2000, it was 3.39%. So to keep your payments up to that, you have a cost of living adjustment. So you draw out more. Otherwise, my dollar doesn't buy as much, right? So if you look at inflation every year, it varies, right? Lately, it's been a lot higher than normal. 2021, it was 7%. 2022 was 6.45. So you would have to adjust the payments you're taking out from your portfolio to keep up with inflation. So another way to think about it is if I was getting $5,000 a year 20 years ago, it doesn't buy as much if I was just taking $5,000 a year out now. So indexing is what pension plans will do to try to keep your cash flow up with inflation. Okay, so normally you won't have a pension that matches inflation exactly, but in the examples I gave, like here, I'll share my screen with you just to show you what I mean, and let me know when you can see the screen. So if you look on the screen here, if you look at the year 2000, right, inflation was 3.39%. And you can see the cash flows. This is the person starting with $100,000 at that worst possible time, right? Every year, their cash flows are going up by whatever that rate of inflation was, okay? So this is interesting because if you look at this, this person in a balanced portfolio there's visually starting at the worst possible time. And this is still a 5%, 5.18% return with a best year of 23 and a worst year of 24. Okay. So if you start 1 year in, watch this. If this person retired in 2021 in 2001 instead of 2000, right? Look at the difference in their capital over their lifetime. So I assume we're almost, given last year, that we're 1 year into this badness. Okay. So even if we have 2 more years, inflation adjusted, drawing out 5 to 6% of the portfolio, this person would still have 40% of their capital left 23 years later and would have averaged 5.6%. Okay. So this is the assumption I'm working on right now. We could have 2 more bad years, but you should be very comfortable withdrawing 5 to 6% of your portfolio. It means that if this year is a bad year, we're going to say, hey, your balanced portfolio did really well. We're down 5%. Stocks are down 11. Your return is -7. Stocks were down 20. Last year, as we said, the average balanced portfolio was down 16%. Okay. So, we were not down anywhere near that.
And that kind of follows up on that question being down 8.5% over that period, over this down period, which the bond market, the low risk bond market, having 2 consecutive years of negative returns, which also hasn't happened, where Robert's saying unprecedented. That an average Canadian bond fund, the index over that 2-year period, is down about 17% over that 2-year period. If you were to look at the BMO aggregate bond index, so being down that amount, if you're looking at a balanced portfolio, that's kind of what we keep saying is good relative to what's been going on out there in the world.
Yeah, I wouldn't expect when we have that kind of negative year in the bond market that we're not going to see positive returns in the next 3 to 5 years out of bonds. Maybe not 1 to 2 years. What do you think about that, Elvis? Would you short the bond market right now?
Never a good idea to short anything, because, like they say, the market can stay irrational longer than we can stay solvent, right? Yes. But I think it's quite apparent that because rates have backed up so quickly, a lot of people are concerned about something breaking in the financial system. And unlike previous years, like even during the pandemic, when rates were already quite low to begin with, this time central banks really they can mount a really robust response to anything that goes wrong, whether it's an external shock or whether it's something in the system. They can cut rates really rapidly, and they will. That's been their favored method of response for many, many years. So I think there's an outside chance that we could see rates significantly low in the next year or two. Not outside chance, a really good chance.
Okay. It doesn't look like there's too many other questions. If that's it, we can take those. We're here to answer questions, obviously offline, but in the interest of time, it's been an hour and 40 minutes. Any last ones before we go? Don't see anything popping up. Oh, one last one I saw just pop up. Oh, it was a thank you. Well, we thank all of you as well. And look,
definitely.
Yeah. One of the things that I really need you to do with your advisors and with our team at this period of time is reach out, ask the questions, book more meetings, talk to us about what your concerns are. We're all here to answer those questions. I was saying to the guys the other day, I felt like 2022 is one of the more stressful periods we've been through. It's almost unprecedented that you see stocks and bonds go down that much at one time. So we are kind of in uncharted territory as far as interest rates going up that quickly. usually when this happens, something breaks, right? The central bankers raise the rates too quickly and something breaks. My bet is it's, the consumer in Canada is going to be in a lot of trouble because of these higher interest rates. So we are on top of it. It's our money is in these pools. We make money managing your money. So we don't want to lose money just as badly as you do, but patience is probably a virtue right now. Okay. So, on that note, anything else, guys, that you wanted to add?
No, just, thank you to everybody for spending the time with us today, and just, reach out for questions. We want to hear from you. We're here to help and kind of walk you through it. We have been through these before. Focus on the long term. It's tough for everybody. It's been a slow, painful 2 years. But things aren't always good, and things aren't always bad. And eventually you start to turn around as well.
Okay, thanks for your time, everybody. And remember, this will be available on a replay that will probably be emailed out, so you can take a look at that too. Thanks, team.
And we'll continue doing more of these and continue sending out our shorter videos as well. And we'll try to just keep communicating.
Okay.
All right.
Take care.